You pay your credit card bill in full every single month. You've never paid a cent of interest in your life. You genuinely believe you're beating the system. Here's the uncomfortable truth. You're still making the bank money every single time you tap your card, whether you realize it or not. Today, we're breaking down the real, hidden economics of credit cards, where the money actually comes from, why the system is quietly designed to keep you in debt a little longer than necessary, and who's really paying for all those flight points and cashback rewards you love so much. Let's start with the number that should stop you in your tracks. Total credit card debt in the United States recently crossed $1.28 trillion. Not spending, debt. The actual balance people are carrying month to month that hasn't been paid off. And more than half of all cardholders now say they carry a balance from one month to the next instead of paying it off in full. That single fact is the foundation of almost this entire industry's profit model, because a credit card that gets paid off every month is, from the bank's perspective, a fairly boring product. It's the balance that doesn't go away that turns a simple payment tool into one of the most profitable lending products in modern finance. So let's talk about interest first, because it's still the single biggest source of revenue for most credit card companies. The average interest rate on a credit card right now sits somewhere around 20 to 22%. And if you think that sounds high, you're right. It's dramatically higher than almost any other common form of consumer borrowing. A mortgage, a car loan, even most personal loans. Why can card companies get away with charging so much more? Because credit card debt is unsecured. There's no house or car backing it up if you stop paying. So the bank prices in that extra risk with a much higher rate. Across the entire industry, interest charges alone generate well over $100 billion a year. And every dollar of that comes from exactly one behavior: carrying a balance. If you pay your statement in full every month, you generate zero interest revenue for the bank. The moment you carry even a small balance, interest starts accruing every single day until it's completely paid off. And here's where it gets clever. Credit card interest doesn't just add up once a month. It compounds daily. That means today's interest charge gets added to your balance, and tomorrow's interest is calculated on that new, slightly higher number. Do that every day for a month, and the bank is essentially earning interest on its own interest continuously for as long as any balance remains. On a $10,000 balance at a typical rate, that daily compounding alone can quietly add close to $200 a month before you've even made a payment. Now let's talk about something most people have never actually thought about: minimum payments. That small suggested payment amount on your bill isn't designed to help you pay off your debt quickly. It's calculated to do almost the opposite. Most issuers set the minimum at somewhere around 1 to 2% of your balance, plus whatever interest and fees have accrued, or a flat minimum of $25 to $35, whichever number is larger. This formula is carefully calibrated to keep you paying just enough that you never default, which would cost the bank money, while paying as slowly as humanly possible, which generates the maximum amount of interest over time. It's not a conspiracy, it's just math, quietly working in the bank's favor every single billing cycle. But here's the part that surprises almost everyone. Even if you never carry a balance, even if you're the responsible cardholder who pays everything off religiously, you're still generating revenue for your card issuer every time you swipe. This comes from something called an interchange fee, sometimes called a swipe fee. A small percentage, usually somewhere between 1 and 3% of every transaction, that the merchant pays to the bank just for the privilege of accepting that card. You never see this fee on your statement because you don't pay it directly. The store does. But stores aren't charities, so this cost gets quietly baked into the price of everything you buy, whether you paid with cash or card. In other words, even a cash-paying customer at the same store is indirectly helping fund the credit card system, just without getting any of the rewards. And that leads to one of the more uncomfortable truths in this entire industry. Those flight points, that cashback percentage, that free hotel night you love bragging about. None of it is free. Interchange fees are what fund almost every rewards program in existence. The bank takes a cut from the merchant on every purchase and hands a slice of it back to you as points or cash back as an incentive to keep using that card instead of a competitor's. But since these fees raise prices across the board for everyone, including people who pay cash and never see a single reward point, researchers have pointed out a strange redistribution happening quietly in the background. Cash-paying customers, who statistically tend to have lower incomes and worse access to premium credit, end up subsidizing the rewards enjoyed by cardholders who tend to have higher incomes and better credit profiles. It's a system where, in a very real sense, lower-income shoppers are quietly funding some of the free flights of wealthier cardholders just by buying groceries. There's also a competitive angle here that most people never consider. A relatively small number of large banks control the vast majority of the credit card market, and research from consumer protection regulators has found that the biggest issuers actually charge noticeably higher interest rates, sometimes 8 to 10 percentage points higher, than smaller banks and credit unions for borrowers with the exact same credit profile. When a handful of players control most of a market, the usual competitive pressure that would normally push prices down simply doesn't apply the same way, and the largest, most familiar card brands aren't necessarily giving you the best deal. They're often giving you the most profitable deal for themselves. So how does all of this actually add up for the average person? If you pay in full every month, your damage is mostly invisible. A few extra cents built into retail prices you'd probably pay anyway. But the moment you start carrying a balance, even a small one, you've effectively taken out a loan at a rate higher than almost anything else available to consumers, one that compounds daily and is designed quite deliberately through minimum payment formulas to stick around as long as possible while still technically staying manageable. It's not that credit cards are inherently a trap. Used responsibly, they're a genuinely useful financial tool, but the entire revenue engine behind them is built on the assumption that a meaningful share of users won't use them perfectly, and the system is patient enough to wait for that to happen. So the next time you glance at your card's rewards rate and feel like you're winning, it's worth remembering. Somewhere in that transaction, a merchant paid a fee, a fellow shopper who used cash paid a slightly higher price, and if you've ever carried even a small balance, interest has been quietly compounding in the background the entire time. This is the hidden economics of the credit card industry, a business built not on any single dramatic charge, but on small, steady, almost invisible flows of money that add up to one of the most profitable industries in modern banking. If you found this breakdown useful, let me know in the comments which topic you want us to break down next.